Good morning, everyone. I'm Vince Lancy, and in today's market rundown, we're going to talk about Goldman's new commodity investment theme. It's actually quite good. We'll also cover gold and silver as actual investments, apples to apples, compared to stocks, and why, finally, and why you never trust major indexes for your rates of return. And then we'll look at some market driving news. But first, let's take a look at the markets. The dollar is down 20 at 104.91. 10-year yields are 459, down 2, a breather. S&P 500 is down 6 at 52.47, lower again. The VIX is 14.45, firm. Gold is vacillating around unchanged at 23.37, but silver is 31.35, down 60 cents. Copper is down as well at 463, down 11 cents. So I would think this is somehow China-based and industrial-based and in sympathy with stocks. Throw this out. There are people out there that really lean into the silver stock relationship as a hedge. And when stocks are weak, they will sell silver. So if you sell silver because stocks are weak, if you sell, you might buy gold against it. You also might sell silver to buy gold simply because silver has really come very far in a short period of time. And that ratio may be attracting some bottom fishers. Just keep that in mind. It's not the end of the world. But what you would like to see is gold to hold silver up, not silver to drag gold down. And I think the days of silver dragging gold down are long gone. Now we need gold to pop silver higher. Silver is precious. It goes up. Anyway, WTI is down 3 cents at 79.63. Natural gas is 244, up 2 cents. Bitcoin is up 276 at 67 spot 800. Ethereum 37.39, weakening, down 23. Platinum, palladium both down. That makes sense. At 944, down $13, and platinum 1033, down $2. So there you have it. Your industrial metals are down. I have to look at zinc and aluminum and what have you, but I've seen enough to know that that's pretty much the case. Grains are mixed. Soybeans unchanged. Corn is down 1 at 445, and wheat is 693, down 8. Okay, so you've got a combination in these markets today. This theme today would be, for whatever reason, well, bond yields have been creeping up. Bonds have been poorly absorbed in the marketplace, and that is in combination with other things affecting stock prices. You had consumer confidence was really good. When you take everything and you throw it into a blender, the market, the sophisticated players are figuring out that there's not going to be a rate cut. We have barely less than one rate cut discounted in before the end of the year. So assume no rate cut. Assume that hurts stocks somewhat. Assume that hurts bonds worse. And assume that keeps a lid on rallies in commodities, but it does not kill the secular bull that is the commodity market. Anyway, all right, so let's move on to Goldman's 5Ds. Oh, there's the front page. Well, this was going to be our lead story, but we just put it out there. We wrote a little post there based on research that we got, very news-oriented post. UBS raises silver price target $4 to $36 an ounce. Now, mind you, I think they were at like 27 a year and a half ago. They cite robust industrial demand and market undersupply. I say this to you as precious metals aficionados. They're going to start saying, and I'm not knocking UBS. They're actually a very good precious metals firm. But they're going to start saying what we've been seeing for a long period of time. And they're going to start saying it because it's true. It always has been true, but now the client base is noticing it. And the client base is noticing it. That means you have a grassroots demand. They're not leading the clients down this road. The clients are demanding more coverage of it. This is very, very bullish in general. Rabobank, Michael Every, converted neo-Keynesian, he's starting to sound like. When will gold and silver miners start believing in their product? That's from Monies and Metal. That's a nice little article there. And there's our post from yesterday about Michael Oliver don't selling too soon, or 2 days ago. All right, to the main topic, Goldman's 5Ds. No jokes, guys. All right, they put out a report primarily focused on Europe, which we got today. I mean, we get these things before anyone. We get lucky on these, and we thank our source for that. And embedded in this European morning report, there was a comment about commodities that we thought was interesting. So let's share a little bit of that with you. We remain selectively bullish commodities and expect commodity total returns to rise from 13% year to date to 18% by year end. We see the 5D bull market trends will create structural opportunities in commodities. Those 5Ds are disinvestment, decarbonization and climate change, de-risking, data centers, and defense spending. There you go. I mean, that's actually very good. Disinvestment, people are taking their money out of financials, which are stocks. Decarbonization, can you think of anything more decarbonizing than silver? De-risking, that's the hedging. People are hedging risk. So if you're a central bank, you're hedging fiat. If you're a person who's long bonds, you're hedging long bonds by buying gold. Data centers and AI, well, they're kind of lumping that in there, but sure, silver and copper are key to that. But you can't underestimate it. The bottom line is the world just needs physicality is on the rise to support all these new ideas that we have. And defense spending, who knows how much silver goes into a missile. All right, we have that at the bottom. It includes refreshed price targets for gold, oil, and copper. I won't tell you the numbers, but I will share with you. If you don't know already, gold has about 15% more upside for them. Oil, they look at it to be in a range, and we're about in the middle of that range now, but it has a lot of upside in it. And I think that upside is going to happen. And copper, another 15% to the upside in LME terms, which means in COMEX terms, it could be 30%. And that continues at the bottom. All right, moving on. Rates of return and risk. I have a mutual friend on X, Twitter, for those of you that don't like the name X. And he's been putting out increasingly interesting charts. I believe his name is Semper Vigilante, kind of like Bond Vigilante. Anyway, always faithful. He brings a traditional financial analytical skew to his work, and he throws a lot of good content up there, and it's very monolithic. He's focused on the prize, silver and gold, and then he relates them to other assets. And of course, there's some humor in there that's close to my heart. But I'm going to show you two charts of his. And the reason I'm showing them to you, aside from the fact that the data is good, the presentation is good, is because they caught me by surprise, which tells me how much even I, one of the faithful, have been influenced by the outside forces. So here's the first one. Sharp ratio of stocks, bonds, and gold from 2019 to 2024. Now, maybe the colors don't show up because of the black background that well, but QQQ is in first place with a sharp ratio of 0.89. In second place is GLD. And don't even look for silver, but it's in there, right? But it's in the top 5. That's what's interesting about it. QQQ is in first place, okay? GLD is in second. The SPY is in third. SLV is in fourth. JP Morgan is in fifth. ARC is in sixth. KRE is in seventh. It looks like ISO is in eighth. Disney's in ninth. And way all at the right, extremely negative, is TLT. Now, if you're not familiar with sharp ratios are a ratio of return on your money versus risk, and the risk is measured by volatility. So on any given day, a stock can have a lot of move back and forth, but over the long run, it makes money. So to have a high Sharpe ratio is to imply a good rate of return with low volatility. Now, there's imperfections with that measure, but it's a standard, and it's a very important standard for measuring stocks. And I like the fact that he's including commodities in there to do that. That was surprising. That was very surprising. It was surprising that silver was number 4. Okay, so if you're looking at risk return, only QQQ was higher than GLD. Now, why was QQQ higher than GLD? Because there is no risk. We'll come to that right now. Looking at just raw returns from 2019 to 2024, QQQ is 162%, SLV is 113.7%, SPY is 91.1%, JP, he's using examples of prime players in industries. JP Morgan, GLD comes in at 75.27%, and on down the line. And of course, you've got at the very right-hand side, you've got FXY. Now, this is also interesting because before I looked at this, I expected SLV to be where it was. And I expected QQQ to be where it was. Now, I pay attention to these things. But when you look at this and you look at, here's a meta comment for you. If QQQ is the highest rate of return, NASDAQ stocks, tech stocks, and you say, I'm not surprised at that, and SLV is the second highest, and you say, oh, that's pretty cool, but it makes sense because silver is very volatile. But then you go back to that previous chart and you say, wait a minute, QQQ is not only the highest rate of return, but it's also the highest risk-adjusted rate of return. Well, then that's bullshit. And that shows you that there's a Fed put out there. How could tech stocks have the lowest volatility given their rate of return? You follow? The whole thing is cooked. And negative naysayer stuff aside, silver is number 2. So take out the market QQQ, and silver is number 1 for cumulative return, and gold is number 1 for best Sharpe ratio. We're number 1. All right, guys? So let's start acting it. We're making some money now, and we're the right way. Anyway, his name, he has a Substack. I haven't done this before, but I'm doing it for the first time. Semper Vigilant 1, I guess the 1 is for the I, on Substack. I'm not sure what kind of content he puts there yet, but I'm going to reach out to him today. And here he is on Twitter. So he's criminally underfollowed for his charts. And if you can understand his humor, if you're older, it's hard to understand humor like that, but he knows what he's saying. All right, moving on. Market news. All right, I want to, market news. BHP has dropped their bid. ConocoPhillips is merging with Marathon Oil. There's going to be more of that in the oil industry. The Cleveland Federal Reserve has appointed another talking head to replace their previous talking head, who has something like 30 years experience at Goldman Sachs, surprise, the revolving door. And this one, Salesforce shares plummeted as much as 17% in extended trading on Wednesday after the cloud software vendor reported weaker than expected revenue and issued guidance that trailed Wall Street's expectations. Source, CNBC. Why am I paying attention to this? Because on August 24th of 2020, let me bring this up a little bit so you can see the dates. Right, there's 2020. August 24th, there's a guy on Twitter, I forget his name, Bucco, the Sopranos character. He seems to be a well-versed macro guy. Anyway, he noticed that the Salesforce was put into was the S&P or the Dow? I think it was the Dow, put into the Dow on August 24th, replacing Exxon. And there in that little rectangle there, that's Exxon being pulled out of the industrial average and replaced by Salesforce, some ethereal, job placement monster.com broker. And there you can see what happened. The moral of the story is indexes lie. Okay. All indexes do to keep themselves at the top right, is they replace the loser. They're always firing the worst employee, okay, and replacing it with the highest performing employee, which is how you run a business sometimes. The problem is when you do that with stocks, all you're doing is selling low and buying high, selling low and buying high. So the reason the S&P 500, one of the reasons indices keep going up is because they constantly replace the lowest performing one with the highest performing one. So that may be okay as a representation of market leadership, but it's not okay as a representation of who merits being in the index or not. Okay. So indices are kind of bullshit. Geopolitics, we're going to skip those for now. Light day. We have GDP today, which should be interesting. And continuing again at bottom, we have two reports. We have Goldman's report that we just discussed, and we also have the daily report from ING on commodities. And we find that their comment about precious metals is very confirming of what we're all suspecting out there. And that is that what happens in China affects our markets more and more. And you're seeing it in base metals and precious metals mostly. I'm Vince. Let's check back on the markets. I'll give you a little screenshot there. There's the gold monthly. Gold's down $1, silver's down 62 cents. Stocks are weaker. Have a great day. See you tomorrow.